Hey everyone, thanks for tuning into this episode of the podcast. Um, this episode I did over Zoom, which I will always prefer to do in-person talks when possible, but sometimes, like in this case, Drew lives out of state, so there's just no way to bring him in. So it went really well. There's a little bit of buffering, but overall it actually went very smoothly. So I will always strive to do in-person talks whenever possible, but you know, if it comes down to it, I would rather talk to someone over Zoom than not talk to them at all. So without any further ado, this is my conversation with Drew Marks, who's been a friend of mine since elementary school, and he is now studying international business and economics at the University of South Carolina. Thank you. Hello.
Hello, hello.
Hey, what's up, bro? How's it going, man?
Good. How about yourself?
You good, dude? All right, let's see. Is my audio good on your end?
Yeah.
All right.
Does it sound decent for me?
Yeah. Bet.
Perfect.
All right, sweet, bro. I appreciate you coming on.
Yeah. Is Thomas coming too, or is it just
Nah,
us?
bro. I've been messaging him like back and forth the past few days, and he's just not opening messages and whatnot. I don't know. He's probably working. I don't know. So it'll just be us, so we can talk as long as we want, whatever we want to talk
Perfect.
about. Yeah, I'm already recording, so we can go ahead and get started. As soon as I saw that there was stuff going on with the stock market, I immediately was like, okay, I got to ask Drew about this. I got to get his opinion because I don't really understand it too well. So for my sake and for anyone who's listening's sake, could you just explain what's going on, why these GameStop stocks are skyrocketing like they
Going
are?
up. Okay. Yeah.
What's
So I'll
going on,
explain
really?
it. So this will kind of be a bit of a lengthy explanation, but
Yeah,
it'll
for
kind
sure.
of like set the stage for what happened now. So there's something called a short squeeze. And essentially how stocks work is you can like buy stocks, right? You can buy shares of a stock, but what you can also do is you can sell short. And what selling short is it's actually selling a stock. So let's say a stock is like $10 right now.
Okay.
You actually are selling a stock that you don't own, and you're taking $10 right now. And then in the future, you're going to buy to cover. And so you end up buying it back. So if you think a stock is going to go down, let's say it's $10 right now, and you think it's going to be $5 next month, you can sell the shares now at $10. And then next month, if it drops to $5, you can buy it back. And so then you make $5 on every single share that you sold short. Does that kind of make sense so far?
I'm a little confused, but I'm kind
Yeah.
of
No, okay. So
getting
pretty
it.
much. Okay. So let's say, right, like Apple stock is $100, right? And for whatever reason, I think Apple is going to tank. It's going to be $50 next month.
Okay.
What's crazy is like I actually am allowed, and especially like people with a lot more money in hedge funds, they can actually sell Apple stock at $100 today. And they're allowed to do this. They don't own it. They can just sell it for $100 because they're making a contract that says sometime in the future, they will buy those shares back and give them back to the people that lent them those shares. So if it goes down to $50, they buy them at $50. They already sold them for $100 sometime in the past, and so they make money on it. What's interesting about selling short is that there's infinite loss potential. So best case scenario, when these shorters, these hedge funds were shorting GameStop, they were doing it right after COVID. It seriously looked like GameStop was going to go bankrupt. And so GameStop shares were around $3 per share. And they shorted these shares, and they were thinking it's going to go bankrupt. And so they're not even going to have to buy these shares back. So they're just going to make however much money that they short. But what happens is there's not a ton of shares available. And GameStop is very weird. So there's what's called a low float. So there's all these shares that exist for GameStop, right?
Okay.
Let's say there's 100 million shares that exist for GameStop. Of those 100 million shares, only about 7 million of those can actually be bought and sold, right? If you're on Robinhood or any other trading platform, you can buy and sell shares, right? But you're actually buying them from someone else. When you click buy, they're not coming out of nowhere. You're taking them from someone else.
So someone else on the app has chosen to sell theirs.
Yes,
and
or
then
not
you're
even
just
on the app,
taking it.
just somewhere on the market.
Right.
Someone chose to sell at the same time.
Okay.
The vast majority of GameStop shares are not tradable. They're held by institutions, or they're held by people working at GameStop, like corporate, and they're just not allowed to sell those shares. So there's a finite number of shares that can be sold.
Okay.
and bought at any given time. That's what we call the float. The float, again, is what can actually be bought and sold out of the actual total of shares. And the float is extremely low on GameStop. What happened was that there were so many people in these hedge funds and institutions were shorting GameStop, and they actually shorted GameStop at higher than the amount of shares that were available to be traded at any given time. So there was actually 140% short on GameStop. And this
How
was
does
like
that happen? Like, how is that possible?
because people were lending shares. I mean, it's again, like there will be regulation changes that come because of this, but essentially more people were shorting the stock than what was available to be bought and sold at any one given point in time.
Okay.
And there was a Redditor last year named Deep Fucking Value, and he put in $50,000, and he pretty much predicted this. And he said, this company is getting shorted at a rate higher than what's available to be bought and sold. So if enough people come and buy the stocks at once, buy these shares, right? Like the limited number of shares that are available, then these shorts are going to be forced to buy to cover at a loss because they're selling these shares that they don't own, which means they have to buy them back eventually. And so what was happening on Reddit towards the end of last year and early into this year is they were trying to buy as much of the float as possible. So there's a small pool of shares that's available. There's more people shorting than the amount of shares that were available. And so everyone's going in and they say, if we buy all of these shares, then all these people that are shorting, they're going to be forced to have to buy, and they're going to buy at like outrageous prices.
So
and that's exactly what we saw.
At what point are they forced to rebuy?
So there was a rumor that last Friday they might have to be forced to rebuy. These selling short contracts can vary. So some selling short contracts have like a set date where, you know, on like X date, you have to give these shares back, and some contracts that doesn't exist, but there's no like set date in general for all of these shorts. Because every short's just a contract between you who's selling shares now and someone else who's lending you those shares to be sold.
Okay.
So it's just a bunch of individual contracts. What's actually really fascinating about this, though, is this is not the first time that this has happened to a company. This has actually happened many times. The best example is in 2008, there was a short squeeze on Volkswagen. And Volkswagen, and mind you, in 2008 financial crisis, Volkswagen was going out of business.
Okay.
And Porsche actually decided to buy a ton of the Volkswagen company, and they bought a ton of the shares. But people in the market didn't realize how many shares that Porsche had bought just over the market. And what happened was there were so many people shorting Volkswagen because they were about to go out of business, and Porsche was buying all these shares, that it ended up being like a 12-to-1 ratio of 12 times as many people shorting the stock as there were shares available to be purchased. And Porsche made an announcement, and they said, look, we understand there's a lot of people shorting Volkswagen right now. We want to let everyone know that we purchased all of these shares, and so you might need to close your position. And it was a mass panic, and you can actually look it up. Volkswagen stock actually went up to over $1,000 in the span of like an hour because everyone's being forced to close their positions. And that's the crazy thing about shorts. When I was alluding to the fact that it's an infinite loss. That's because if you shorted GameStop at $3, right? Every single share that you sold, you got $3. Let's say you sold short 100 shares, right? So in the future, so you made $300 at the beginning. You're hoping they go bankrupt. The most amount of money you can make is $300. But now GameStop has just skyrocketed, right? It's absolutely blown up. Now shares are like $300. You have 100 shares you have to buy back, and now you're having to pay $300 per share.
Yeah.
It's infinite loss. But it's really crazy, and the reason why this GameStop's been a little different, actually it's been different for multiple reasons, but one of the reasons is that people assume, generally speaking, with short squeezes is they're very quick. So with the case of Volkswagen, it hit $1,000, but once enough shorts covered, it just tanked because it wasn't actually worth $1,000. It was just those shares were so highly sought after for that point in time that people were willing to pay $1,000. Obviously, the share itself, Volkswagen was not worth $1,000 per share.
Right.
But with GameStop, the higher it goes, the more people that want to short it, because GameStop is not worth $300 a share. Like a year from now, it's not worth $300 a share. It might be worth $20 a share maybe, right? So there's a lot of money that can be made shorting it. So the higher it goes, you have more people shorting it. You have more of the previous shorts being forced to cover their positions. And then you also have everyone online buying GameStop shares.
So essentially, as the price is going up, from my perspective, as someone who wants to short, say it's worth $100. So I'm selling it. So I'm getting $100 in my pocket.
Yep.
So then eventually when it goes down, I'm only going to have to pay, if let's say it goes down to 25, I'm only having to fork over 25 for that in the future.
Exactly it. And then you make the $75.
Yeah.
But what's interesting is as long as you have people interested in shorting GameStop, and you also have people that are buying GameStop right now, it will continue to go up. And something has to crack. What's really interesting though, again, is because these short squeezes actually happen a couple times a year. The difference is Reddit. And now it's so mainstream. The fact that you can text me, right, someone who's not super familiar with the stock market and ask me about GameStop, and the fact that I've had my grandparents texting me about GameStop, that's the difference. Everyone on Reddit realized once the price started going up, they realized that if everyone worked together, they could completely screw over these hedge funds, because these hedge funds have massive positions.
Explain what a hedge fund is.
So what a hedge fund is it's like a financial institution whose goal is to beat the market. And beating the market, in short, there's an index called like the S&P 500. And that's kind of the gold standard. There's 500 corporations on the S&P 500, and roundabout they'll average about 10% gains per year. What a hedge fund is it's an institution that tries to get greater returns than 10% a year, right? And so it's millionaires. A lot of hedge funds might have like a $5 million minimum, a $10 million minimum, and they use what's called hedges, right? So they hedge their bets and they make riskier plays with the chance of a lot more upside. And hedge funds use all sorts of crazy research. Actually, a lot of hedge funds are accused of having insider information and are actually very hard to prosecute. So that could be one reason why they beat the market. On the whole, the vast majority of hedge funds do not beat the market over an extended period of time. It's just very, very difficult to beat the market. And that's actually another interesting point too. So there's something that's called the markets being efficient. And what the markets being efficient generally means is you and I, believe it or not, can actually look at the financial statements of a particular company. It's called the 10K. And we can perform our own analysis on what we think the share price should be based on their current financial statements and how much we think the company will grow in the future. And if we find a price that is very different from the current share price, then if the market was inefficient, then we could buy at that different price. And then eventually the market would realize what the price should be and we would make money. But what you'll find is, generally speaking, the market is very, very efficient, right? There's so many people trying to find out how much these shares are worth at any given point in time that any analysis you will perform on a company will be very close to the current share price. What we're finding now is the market is becoming more and more inefficient, right? If you perform any amount of analysis on GameStop, they're not worth what they're trading for right now, right? And not only that, are you familiar with IPOs, initial public offering?
No.
Okay, so I can explain that. So an initial public offering is how a corporation goes public, right? So a corporation that wants to trade on the stock market can have an IPO, or an initial public offering. And they use that to raise capital so they can raise money for their business, and in turn, they're selling shares of their company. And it's actually also a way for founders of a company and large shareholders of a company to actually sell some of their ownership of the company. And in turn, they get paid from normal investors like you and I who are buying these shares.
Right.
So what happened in the past year, and especially in the past 6 months, is there were a lot of companies that went public and they started trading for a lot higher than people expected. So a great example is like DoorDash. So DoorDash, I think, was predicted to go around $50 when they went public. So $50 a share. Every analysis that was done on DoorDash said $50 a share is probably very reasonable. However, right now, DoorDash is trading at $200 a share. And the reason why they're trading for so much more, some people would say, is that they believe so much in DoorDash's model that even if they're not making a ton of money now, 5 years from now, they might take over the market. And so they're willing to pay a premium because in the future, they believe in this company. If you look at Tesla right now is trading for around $8.50 a share. Tesla is what we call price to earnings ratio. What price to earnings ratio is pretty much how much they earn in a given year compared to a share price. And what you'll find is Tesla's price to earning ratio is like 1,000, which is extremely high. So they're not making barely any money right now, but so many people believe in Tesla as a company that they're saying that 20 years in the future, they're going to have all of the self-driving cars and they'll have all sorts of other technology. Right. So they're pricing that into the share price now. So if they fail, Tesla's not worth nearly what they're worth now, but people are willing to price that in. The average price to earnings ratio on the S&P 500 index, which again is these 500 corporations that we kind of group together and we set that as a baseline for the market, is 23. So it's a price to earnings ratio of 23.
And Tesla again is
like 1,000.
1,000, dang.
So
okay.
Anytime there's a corporation that has a price to earnings ratio much greater than 23, we call them a growth company, which means that for this company to be worth what their current valuation is, they have to see considerable amount of growth as a company. Or you can also have what's called a value company. And a value company is a company with a price to earnings ratio of less than 23. Value companies are already established and they're making great revenue. So they probably won't grow at the same rate as these growth companies, but they're value picks, right? They're consistent, they're making a lot of money. They're generally safer companies to invest in. Right now, what you're generally seeing is just a bit of an expansion on so many more companies being valued at higher and higher prices, which is just a little bit unconventional in the grand scheme of the
This is just an
market.
overall shift in like the stock market as a whole that we're seeing.
Yes.
Okay.
Yes. Companies, or in other words, like a lot of equities are being valued at more and more money, even though they're not making a lot of money now, because we're pricing in this potential growth in the future. I cannot predict the market. No one can predict the market, but there has to be some sort of correction in the future. And very likely GameStop and the way everyone investing right now will kind of force a sort of a correction. Right. Because I would argue that right now the markets are generally inefficient. And inefficient means that what these stocks are trading at right now is not what they're really worth. People are buying shares of GameStop. They're buying shares of AMC. They're even buying Dogecoin right now. Yeah. They're buying into these corporations or cryptocurrencies, not because they believe in the corporation, but they believe that next week, 2 weeks from now, it'll be worth double what they put in, right? And you can see this over time, right? It's a sort of a greed. So there's so many different times in history where these same things have happened, right? Where people aren't investing because they believe in what they're investing in. They just believe that they can make a quick profit and turn around and sell in the future. Right. When you have enough people doing that same exact thing, they're buying because they think it's going to be double in a week, that creates a bubble, right? Mm-hmm. It's not worth what it's being traded at now, but we think it'll still go up in the future. So I'm willing to take a risk because I want to make a quick buck. Mm-hmm. And enough people are doing that right now that eventually it will burst. I could not tell you if GameStop's going to tank on Monday. I couldn't tell you if it's going to tank in 2 weeks. Maybe it takes a month or two. It can't last forever because never in history has it lasted forever. GameStop's not worth that. But as long as enough people believe that it will still go up day after day after day, it will continue to increase.
Yeah, and a lot of people are probably seeing all this going on and just wanting to hop on the bandwagon of making a couple bucks because they see all these people online posting these thousands and thousands of dollars gains that they're making, and they just want to get a little bit. So that just keeps inflating it even more and more.
Yep, absolutely. And that's the interesting thing with these short squeezes is generally speaking, they're very, very quick because once the stock gets squeezed up really high, everyone who owns the stock immediately sells. because they have such a high profit and they want to cash out. What's so fascinating about GameStop is it's kind of been made into a bit of a David versus Goliath mentality, where you have
Yeah.
all of these individual retail investors buying and not selling because they're trying to screw over these hedge funds.
Yeah.
Because they see these hedge funds as just like this evil entity of really, really rich people and rich money. And they're saying, I'm not going to take my profit right now because I want to hurt that, right?
Mm-hmm.
And so what's really interesting is the first person on Reddit who is really all in on GameStop, he hasn't sold yet. He made a $50,000 position a year ago. That position 2 days ago was worth 50 million. And what's crazy is I've been watching it. He posts at the end of like when the markets close every single day, he posts his current positions and he hasn't sold. He still owns. And it was crazy because like he would post and it's worth like 700,000 and people were like, oh my goodness, I can't believe you made that. Are you going to sell? And he's like, I'm still holding. It was to like 3 million. And people were like, I cannot believe you didn't sell today. And he's like, I'm still holding. It's going to go to $1,000. And it hits like $60, right? And people are like, you're worth 7 million. I'm not selling. It's going to hit 1,000. It's hit 480 at one point in time. He was worth about $70 million on this $50,000 investment.
So what are we looking? What is it looking at? If you know right now, today is Sunday, January the 31st, around noon for anyone listening. So do you know what it's at roughly right now?
Yes, I can actually pull it up. I actually should have had this pulled up already. So right now it's at $325 at market close.
Okay.
So it's $325 at market close. He actually lost a lot of money on Friday. I want to say, or actually it might have been on Thursday, lost a lot of money. There was one day he lost like $20 million.
Yeah, I remember like Thursday, me and Thomas were talking about it because Thomas had some shares. So we were just, he's keeping me updated. And I think it was Thursday afternoon that it tanked. And what's interesting is I also saw like Naked stocks. I don't know what that has to do with anything, but it seems like Naked and then a couple other brands have just been brought into this movement.
Absolutely.
What do you know why that is?
Yeah, so this is what's crazy. So people always, I mean, this is just like human, psychology almost. People want to make a quick profit. Mm-hmm. And people hate being left out. There's a lot of people that are seeing GameStop skyrocketing and they think they missed the bus. But they don't want to miss the bus, right? No one likes to think that they missed out on the next big thing.
Yeah.
And so they're trying to artificially create this next big thing.
Yeah.
And so there's a lot of other stocks that everyone online has done the same exact thing that they did to GameStop. So they did it to AMC, right? Movies. They did it to BlackBerry. They did it to the stereo company called Cost. And this is actually interesting for me. So last Tuesday, I started a stock game in one of my finance classes. Mm-hmm. And so 10% of our grade is just investing in the stock market. And I am only allowed to short stock. I'm not allowed to buy anything. I have to sell short for all of my money. Cost is a company. They have 37 employees and they sell stereos and headphones on Amazon. And if you look them up, they're garbage. So one of the headphones they sell is like $6. Their average one is like $20. They don't have great reviews. Mm-hmm. They were trading for $3 a share and not moving a week ago. They went up to $110 because they have such a low volume that people decided if everyone buys it once, it'll drive up the stock price. Mm. And I actually sold short in this game on Cost. And currently, I had $100,000 to invest, and currently I'm worth negative $200,000. Now, eventually, I would have to think I'll make my money back. I'm not particularly worried because my professor, a lot of people in our class actually are bankrupt, the people that were forced to sell short. And he's like, obviously, I'm not going to hold this against you. But it's fascinating because the reason why Cost isn't going down right now is because there's so many people in real life thinking the same exact thing. So like, it's worth so much now, we're going to sell short. But the more people that sell short is going to force more people to buy. And eventually, if these shorts lose enough money, they're going to be forced to cover their position.
So this is just a random company. There's no reason why people pick this specific one.
They picked it specifically because there's an extremely low float. So there's not many shares that can be bought and sold.
Okay.
And so if everyone buys all the shares that can be bought and sold, right, the less supply that's out in the market will drive up price. It's simple, supply and demand. Demand increases, there's a lessening of quantity supplied, and price will increase.
Yeah.
And that's what we're seeing right now.
So with GameStop and AMC, BlackBerry, these bigger companies, were these specific companies chosen because these were the companies that these billionaires were selling short and they wanted to screw them over? That's specifically
exactly
why those?
it.
Okay.
So there's actually a really interesting article that I was reading the other day, and the top 10 most shorted stocks of the past month have increased over 100% on average. So this is all public knowledge. You can actually read up on the most common shorted stocks. All of these stocks were stocks that were looking like they were going bankrupt. AMC looked like they were going bankrupt. So many people are shorting these stocks that everyone decided we're going to buy. Now, the difference between all of these random corporations and GameStop is the only corporation that still has and actually had a higher short to float ratio, which means there are more people shorting than shares available. AMC doesn't have that. I think AMC was 70%. So it wasn't this crazy ratio, but like anything else, if enough people decide that's going to go up and they buy, then it will.
Right.
But eventually it will correct. It will go down, and there will be a lot of people holding these shares that are completely worthless.
Yeah. So what do you think about, I know Robinhood actually closed, they closed GME, they closed AMC, and you could still sell them. If I understood correctly, you could still sell them, but you couldn't buy. And I've seen a lot of people saying that this is like Robinhood is in the wrong here, and that the SEC is going to come after them. So what do you predict is going to come of Robinhood doing this?
So it's actually very, very fascinating, especially since Robinhood is actually a company that wants to become public. So they actually will have an IPO, so an initial public offering later this year.
Okay.
In short, Robinhood is in the wrong. What they did, in my mind, is completely illegal. You cannot force people to only sell their shares and not allow them to buy, because that does not make the market fair in the slightest, right?
Right.
Because what I predicted when that happened was that GameStop was going to tank and this was going to end. What's crazy is people didn't sell their shares when they had the option to. Everyone was like, we're going to hold, eventually they'll let us buy. And actually on Friday, they opened it up to limited buying. So now people can buy GameStop again. But what was intended by Robinhood was they just wanted this to be done and over with. Robinhood is getting so much publicity, and generally speaking, you might say, the more publicity, the better, but this might not be great publicity for Robinhood. And the reason why is because there's a case to be made that what's going on right now is market manipulation, right? Everyone coming together and deciding we're going to buy this stock for the sole purpose of driving up the price artificially, that is market manipulation. Mm-hmm. Hedge funds have done it in the past. They tend to not get in trouble. And it's different having a hedge fund or a couple hedge funds agree, right, to buy a bunch of shares at once to artificially drive up the price versus millions of people deciding to hop on the train and do the same thing. Yeah. So obviously not all of these people can get prosecuted. There might be some people that were using bots or whatever to artificially hype it up, and maybe they get in trouble.
Yeah.
There's definitely two sides of the coin here, and neither side's probably in the right, but for Robinhood specifically, they're just a trading brokerage, right? They're just a platform. They should have stayed out of this. They shouldn't have forced people or not allowed them to buy, or in some cases, there were rumors that they were forcing people to sell, or at least strongly encouraging it. If they would have done absolutely nothing. So part of it is, well, for one, I'll kind of say another thing too, is these like stock markets can actually halt trading. So like on GameStop, what was happening is they were moving so much in the span of like 5 minutes that they actually put a halt on trading, and they don't allow trading for like 5 minutes. And then they'll open it back up and then jumps or falls like 10%. And like,
is this a regular thing that happens or only in very specific situations like
very,
this?
very specific circumstances does it
Okay.
ever happen. And they do it for a reason. So it's really interesting is there's all these companies, and you mentioned Naked Brands is another one. There's all these companies that are just skyrocketing for no reason. And what's interesting is these corporations actually come out with statements anytime their share price moves too much in a day. And their statement is quite simply, we have released no news that we feel indicates why the price of our shares increased 100% over the day. And generally when this happens is that the stock market, in particular, whether it's the NASDAQ or what have you, they will just halt trading on that company for a day. Okay. Because they want to look into why it went up, because a lot of times there's market manipulation or something fishy going on. They have been halting trading on so many companies in the past week because there's so many that are spiking up for no reason, but they can't halt them forever, right? If people want to buy them, eventually they're going to let people buy these shares. And so they'll just halt them for 5 minutes and then they'll open it back up. So like GameStop in some days is getting halted 20 or 30 times in a day. And they just open it back up. So, I mean, the whole thing, it really is unprecedented because so many people are involved with it. But again, eventually it has to go down. Like it's not sustainable.
Yeah. It seems like this just points out like flaws in the system. And like you said, it's definitely going to need to lead to regulation, because if I understand correctly, it seems like hedge funds do this very same thing, just on a much smaller scale. So now it's almost like these Reddit people, they were almost right when they say they come together to stick it to the man. You know, these hedge funds have been getting away with this for so long. Here you go. You're not going to prosecute them. Here's what happens when you let this go
when you let it happen. And that's the thing. And that's how a lot of people see it. And in many ways, it's absolutely correct. One perspective I would like to share is from Dr. Ostergaard, which is my international business professor. He has extensive experience in security.
And you're at the University of South Carolina, correct?
University of South Carolina, that's right. And he actually worked with President Bush for a while as an advisor. He's very experienced. He was a captain in the Coast Guard. So he just has kind of a lot of experience in security. Yeah. And what he was saying is a lot of foreign entities that have reason to harm our government and our way of thinking as Americans may hop in or may have hopped in on this kind of fiasco in the stock markets right now just to create uncertainty. Because the flip side of this, it sounds great to screw over these, few hedge funds that have been shorting GameStop, and that's fine. But this is also creating a lot of distrust in the market because people, right? Like these shares are not being sold for what they're really worth realistically. These companies are not worth the valuations they have. And the more people that become disenfranchised or become distrusting of our stock market can have wide-ranging implications that could potentially cause some sort of recession, an actual market crash that could cost millions of jobs to Americans.
Yeah, right? I was thinking about that the other day. That me and Thomas were talking about it. It's like, this seems it's crazy that this happened, and it's cool. It's almost fascinating to watch in its little bubble. But yeah, like you said, the implications of it, if people don't trust the market, this could lead to massive, massive stock crashes. And that can screw over a lot of people, because a lot of people live off of these investments. A lot of middle-class people, I mean, rich people especially, people could lose a lot of money off of this.
People could lose a lot of money.
Involved at all.
And even worse is these investments help corporations, and they help corporations invest in themselves and grow, right? So corporations take this money and they can invest in research and development to invent new products, new technology, new software that really innovates and creates jobs and growth, right? We have to invest in the stock market. Just people have to have money in the stock market in general, because that's how we innovate and grow as a society. Right. So if enough people don't trust the stock market and they pull their money out, you will see a decline to some extent of technology and growth in the future. So it is a very big deal because this has wide-ranging implications.
Yeah, I would think especially in a company like Tesla, like you were saying, where they aren't bringing in lots, they don't have a very big profit margin. So if the stock market collapses and they're, what did you say, 1,000%?
Yeah, 1,000 price to earnings ratio the last time I
Yeah.
had checked.
Yeah. So that's huge if that money gets taken away from them, because if they aren't bringing in much profits, how are they going to do research and development and all these things?
And it's just on such a macro scale, because
Yeah.
if enough people take their money out of the stock market, you will see a recession and you will see a loss in jobs, right?
Mm-hmm.
Companies will have to downsize and they'll have to have layoffs, and it can affect so much. So that's why Dr. Ostergaard was suggesting the possibility. And he said, with some of the research that he does and the consulting firm he works for, actually, he works for a consulting firm in Eastern Europe, actually. They have the ability with some of these countries. They actually have these contracts to where they're actually allowed to look through the history of every single smartphone in these countries. Like, this is insane. And they
Really?
look through the data, just like the metadata of like every single Google search, every single text, and they look for trends and they look for bots. And what they're looking for is they're looking for some sort of manipulation or foreign influence. And what we may end up finding, a month from now, maybe a year from now, is yes, this started as something small and organic and grassroots almost on Reddit, but other countries saw the opportunity to manipulate and create distrust in America. And they hop in on it and they kind of sow those seeds. Now, again, I can't say that for certain. I have no clue, but to some extent that has to be considered as well. There's just so much that goes on with something like this that it's cool to look at it, but in the really macro picture, there are a lot of potential concerns with what's going on right now.
Yeah, definitely, especially with this past election and how much distrust there already is in the US government right now. It seems like a perfect time for other countries to hop in and just sow more seeds of distrust. I don't know what their end goal is. I don't want to try to predict that, but it seems like this could be a really big issue.
No,
It's
it really
going
could
right
be.
under most people's radars.
No, absolutely. And what's actually fascinating for me is this relates very much into the research that I'm interested in my potential career in the future. So I'm actually going to go study abroad my junior year in Daugavpils, Latvia, and St. Petersburg, Russia.
Nice.
And while I'm there, I'm actually going to conduct research. I'm actually writing a thesis proposal right now that I'll write my senior year of college, where I'm going to talk about the economic attitudes of citizens in Latvia and in Russia. And so I'll kind of understand their perspective and kind of their relationship. But eventually, I'm extremely interested in understanding how these countries work, how these governments work, what motivates their people, what motivates their governments, why do they do the things they do? Because we have to be able to understand how they think so we can react as the American government and as the American people.
Yeah, listen, once you're over there doing all that, I'm definitely interested in talking to you again and getting more information on that, because that's extremely fascinating. Wow.
No, I'm very excited, and once I conduct enough research, I would absolutely love to come back on and I could talk specifically about some of the research that I've done and the people I've talked to.
Yeah, I'm sure you'll have some crazy stuff to say.
It'll definitely be interesting, but it's definitely exciting for me. It's interesting being able to relate what's happening with GameStop to some of my potential career interests in the future. But you honestly could make the connection between GameStop and a lot of things, and it's crazy how we even now can kind of connect GameStop and how it's trading to just every part of the economy and truly every part of everyday life. Because there very well could be far-reaching consequences of this. Maybe not, but it's definitely possible. And regardless, this is something that we'll look back 5-10 years from now and still remember, because it is just completely unprecedented.
Yeah. If there's going to be regulation, what kind of regulation do you think we may see come out of this?
It's honestly very, very hard to tell right now. For one, I really, really think we will see regulation on trading platforms and brokerages such as Robinhood that inhibit preventing people from buying shares of any company, right? They should not be the ones that do that. If the actual stock market exchange, such as NASDAQ, says we're going to close trading for the day, they can do that. But an individual corporation should not be deciding, because what is a very, very easy conclusion to come to, and maybe this is unfounded, maybe it isn't, is Robinhood is potentially working with these hedge funds to close trading to drive down the shares.
Yeah.
So that way they can close their positions and save some money.
Yeah,
right?
definitely.
Because there's not a ton of reason why Robinhood would shut down trading, because one way or the other, they still are making money as a platform.
Yeah.
So that's definitely regulation we'll see. Again, I think there has to be some sort of regulation that comes out in terms of when these prices are being manipulated. Maybe it gets shut down for 3 days or so, and there's just a full investigation by the SEC, so the Securities Exchange Commission, understanding exactly what's going on to make sure that there isn't anything illegal and there isn't any foreign influence potentially that's happening in the market. And I also think you'll see a general trend in the future where you may never again see a company with a short ratio that is higher than the float of the corporation.
Yeah, that seems
right?
like that
Because
shouldn't
this
be
has happened
allowed.
a lot in the past, and many times there's a short to float ratio greater than 1 and nothing happens. There's no squeeze because there has to be some sort of catalyst that starts the squeeze, either a hedge fund or multiple hedge funds buying up the float, or for the first time ever in this case, a bunch of individuals deciding to play the role of the hedge fund and doing the same exact thing.
Yeah, there's a lot going on here. A lot going on here. That's why I wanted to get you on to talk about this, because I was trying to understand all this stuff reading online, and it's just so many things at work here.
Absolutely. And
Yeah.
even me, like, I would be lying if I said I understood this completely. I'd be lying if I said I understood this 50%. This is just my perspective and the research and readings that I have done.
Right.
It's obviously an extremely, extremely complex issue. And I can't predict the future. I don't think anyone right now can predict the future. And that's what makes it worth talking about. It's so important to understand these different perspectives and really understand that it's not just as simple as a David versus Goliath. It's not just as simple as people are breaking the law, it's market manipulations, they should be prosecuted, right? There's so many facets and there's so many implications and potential implications from what's happened in the past week, 2 weeks in the stock market. And it's just very, very important to stay informed and try to understand as best we can kind of the implications and potential consequences that might come because of that.
Yeah. For the regular everyday person who's not involved in the stock market, who doesn't keep up with all this stuff, what would you advise for them to do in terms of this, in terms of what should they be looking for? What kinds of red flags should they be looking for in the economy and in the stock market of things that may come back to affect them? Like you said, how what's going on right now could cause a recession. Are there any red flags in the stock market that people who don't know a lot about it can just be looking for and keep their eye out?
Absolutely. So first off, no one individual can prevent a recession. And many times we say that there might be a catalyst for a recession, but the recession was going to happen regardless of the catalyst, right? There just would have been another one.
Yeah.
The one piece of advice that I would give to everyone ever, when you're considering making an investment, understand why you're making the investment. If you cannot convince yourself that it is a sound investment, don't do it, right? So for instance, buying GameStop, it's very tempting and you very easily can make a lot of money. But are you buying GameStop because you believe in them as a corporation and you believe that you will have a high return on investment because the company is growing and developing and making more sales and potentially producing new technology that will increase their future revenue growth? Or are you investing in them because you think next week it's going to be worth double, right? It's as simple as that. If you're buying into anything ever because you think it will increase very quickly in the future, you're not contributing anything to the company, right? Generally speaking, when we talk about investment, you see return on investment because you're taking some amount of risk, right? I am believing in corporation X because I believe they will develop and continue to grow, and eventually they will make money and I will make my money back and more, right? That's how investing should work. That's the definition of investing. So whenever you find people investing because they think next week it's worth double, they're not contributing anything to the company, and the company isn't giving anything back to them, right? They're just selling to some other schmuck who thinks it's going to double off that investment. But eventually what will happen is you're holding and there's no one who thinks it's going to go up even further. And once people stop believing it will go up even further from what it's currently at, you'll see a complete decrease in demand, and then everyone will start selling, and then it'll become worthless, and a lot of people will lose money.
Yeah.
So it's very easy to get caught up in these things, but if you don't understand it, don't do it, because there are actual risks, and there will be a lot of average everyday Americans that lose a lot of money because they're extremely excited and hyped up and they want to make a lot of money. But instead, they're going to be left holding the bag with a relatively worthless investment.
Yeah, and especially, and this probably seems very obvious to someone like you, especially, but don't invest money you aren't willing to lose 100% of. Because I
Absolutely.
get, so when I see something like this happen, if you want to throw a couple bucks in it and try to make a few bucks here and there, okay, fine. You know, I don't have a problem with that. I when I saw this going down, I put a few dollars into it because I was like,
Yeah,
hey,
of
whatever.
course.
If I can make 20 bucks in a day, cool. 20 bucks from
Cool.
no
I'll do
more.
it.
But nothing that if I lost it completely, when I put it in there, I assume I'm not going to get that money back.
That's the way to look at it. And the thing truly with investing is there's a way to invest to where you don't have to be willing to lose everything, right? If you invest in the S&P 500, you will not lose all of your money. At most,
Right.
there's a 20% correction. You'll make it back in 2 or 3 years. In 10 years, your money might be like 1.5 or 2 times what it is currently.
Mm-hmm.
That's extremely safe. And
Yeah.
what I would recommend to everyone is understand how much cash you want to have saved at any given point in time. And if you know you're not touching money for a year, 2 years, 5 years, invest it in something like the S&P 500. It's extremely simple, very low fees. You could just get an ETF that tracks the S&P 500, and then that way you'll grow your money
What's an ETF?
while you're not touching it. An ETF is an exchange traded fund, and it actually trades just like a stock, right? So you can buy and sell shares of Apple. You can buy and sell shares of this ETF. What the ETF is it's an entity that owns an equal weighting to the S&P 500. So for instance, an S&P 500 ETF will track the exact same as the actual index. So it owns all 500 of those companies' shares at the same weight as what the S&P 500 has. And so if the S&P 500 goes up 1% in a day, the ETF goes up 1% in a day. If it goes down, it goes down. And as more people put money into this ETF, it'll just buy more of these shares at this equal rating, or weighting rather.
So what's the point of an ETF then?
So the point of an ETF is if I'm an individual investor and I want to make money that tracks the S&P 500, which again is just this conglomerate of 500 corporations. If I wanted to do that, I would have to own shares of every single company.
I see.
Some shares are expensive. Amazon's on the S&P, they're trading for like 3,000 or something like that, right? It's very difficult. And not only that is you have to have the specific weighting, and the weighting changes. And sometimes companies get added or subtracted from the S&P 500. Instead of that, there's just an ETF that you can buy, and the ETF will track the S&P 500 for you.
Okay.
And so you just invest in this ETF and you can buy and sell it just like a stock, except it's a stock that just tracks this index. So there's ETFs for everything. Again, I highly, highly recommend if you don't know what you're doing with your money, put it in the S&P 500. It is safe. It will make money over time. That is money that you can look at and say, I'm fine if I lose 20% in a year, but I know in a couple of years I'll make it back. And if I'm leaving it in for 5 or 10 years, I could double my money or potentially a lot more than that. So that's very valuable.
Okay. Yeah. When you say put your money in the S&P 500, from a practical standpoint, what that would really mean is money into the ETF, unless you wanted to go and buy specific shares.
Yes, which you would not do. So you just put it into the ETF. So there's an ETF with the ticker VOO. Mm-hmm. There's another ticker SPY. Both of those track the S&P 500. And they have very low fees. Okay. And so you're paying an extremely low expense ratio because obviously the ETF itself has to manage this money and invest it. So they take just a tiny, tiny fraction of your money to do so. This is safe. And then if you want to have money that you're willing to gamble a little bit, that's called speculative investing. I do the same thing, right? I have my investments that are safe and I expect will grow in 5-10 years. I know it's not money I'm going to need for a little while. And then I'll give myself a couple $100 on a Robinhood account. And if I want to play around with GameStop or with options, it's money that I'm willing to lose it all and I'm not going to lose sleep over, right? Yeah. So that way I'm allowed to experiment in the market. If I see a trend and I believe in it, I can buy it. Maybe I could buy some Bitcoin or something, right? Or, Dogecoin, not that I would do that, right? But I have the freedom to invest a little bit of money. But it's speculative, right? I'm going for high risk, high reward. And if I lose it, I'm not losing sleep. And then I actually have investments that are like savings. And the
Yeah.
big concern, kind of tying this back up to GameStop, is so many people, and really every average everyday American, if you have the ability to save it all, you should have some money in the stock market because it's the best way to grow your money. Leaving money in a bank account for 20 years is just not going to grow. And with the
Right.
time value of money, it is just so much more valuable to invest it.
Yeah.
What I hope comes of this is everyone with Robinhood and everything else is really excited to invest, but they take it seriously and they actually invest savings. But what could happen, and my biggest concern, is that people lose faith in the stock market and there's a trend of people taking out their money and it really could set things back because it's very
Yeah.
valuable to be able to put your money into some of these larger corporations that we know, it's in enough of them. Even if one went bankrupt, the other 499 won't, right? It's very safe.
Mm-hmm.
But again, the more distrust there is in the market, the more unsafe that is.
Yeah. So having this conversation now, I feel like I know where the market's at right now and what's going on right now. But in the future, for myself or anyone who wants to keep up with this stuff, what resources should someone like myself look to keep up with this stuff and to stay up to date with what's happening in this whole stock world and the investment world, so I don't get behind?
Absolutely. So first off, I would highly recommend the Wall Street Journal. That is a great way to read. Truly, just reading and staying informed in general. If you have like a couple different news sources, they can even be like global news sources. BBC is a great one. NPR is a great one. Al Jazeera is a great one. Just reading and staying up to date, not only with the market, but current events, because current events change the market. And just trying to stay as informed as you possibly can. It only takes like 10 minutes a day. Just read a couple news articles, just try to stay informed and understand what's happening. So that way, if something big happens, you're not playing catch up.
Yeah.
But the other thing too is if you're investing safely and you're investing in an ETF that tracks S&P 500 or just like larger corporations like Walmart, Amazon, Apple, things like that, you really don't need a ton of day-to-day information because over time, these investments will grow. You really have to stay up to date if you're making these speculative investments and potentially you're day trading or making these shorter term investments where you really have to keep tabs. But as long as people try to stay informed in general, that's just the best thing that you can do.
Yeah.
Because a situation like this is very rare, but it will happen again in the future. And it's just great to understand, and maybe you could be able to predict this because a lot of people on Reddit predicted this.
Yeah.
And they happen to make a good amount of money from it.
Right. So what would you say? Because I know a lot of people would probably love to get into the stock market and would love to invest, but a lot of people just feel like they don't have the income to be able to put towards that. So from your perspective, and this is something that's going to be very opinion based, and I'm sure different people would have different answers, but what would you say for someone working, say, like a low income job who doesn't have, they don't have the funds to put away 40% of their income into savings? They aren't able to make these big long-term investments. What would you say is a good strategy for them to maybe slowly get money into the stock market?
So my only thing, and obviously there's a level of income where this is just not possible.
Mm-hmm.
What I would generally say is try to not live beyond your means. And that is the single, here one second, I have to go off really quick.
No, you're good.
Apologies. That's the single most important thing. I think with a lot of people, if they're lower income for a long amount of time, the second they get that bonus, the second they get that promotion and they get that pay upgrade, what's the first thing they do? They go out and they buy a really nice car and they say, I haven't had money for so long. I want this nicer car, right?
Yeah.
I want this nicer house. I want to upgrade and improve my life. I want a new phone, right? They want to reward themselves.
Yeah.
And that's awesome. And I'm not going to disagree with that. But if you're capable of living at a certain standard of living, and then all of a sudden you get a promotion or some sort of pay increase, you can still live the way you were living and try to save a little bit of that money. Mm-hmm. And people, whenever they try to extend their means of living beyond how much money they're actually making, and every time they get a promotion, every time they get a pay increase, they just try to upgrade their standard of living, they're not going to be able to save. And so I think everyone, again, it's like a continuum, right? I'm not saying don't go out and buy anything when you get a bonus, but I'm also saying don't blow it all immediately, right? Don't max out your credit card just because you got a new job and it's paying more money. You have to be able to save some amount of money, because when you save money, if something happens, right? If you lose your job, if you need to cover rent, that's how you do it, right? You have to have some sort of money. Or best case scenario, you don't lose your job. You have these investments. One day you want to buy a house, you have money for a down payment, right? I mean, this is why you have these investments. It shouldn't sit in an account your entire life. It's just you save a little bit at a time. So again, my single piece of advice would be, look at what your spending habits are now. What is frivolous? What could you actually cut out? And of what you can cut out, just give yourself a little bit of that towards savings. And as you work your way through life and you have different jobs and hopefully make a bit more money, try to increase that saving more and more every step of the way. So yes, you can increase your standard of living, but also really focus on investing as well.
Yeah, I think what you said there is really important, that a lot of people don't have any kind of money in the bank. So then when stuff happens in their life, when their car breaks down, they have to go get an oil change, sometimes things like that you can even predict in the future. And then people act like they're the victim, like, oh man, this stuff's just coming up in life, I can't do anything about it. It's like, okay, well, you bought $1,000 phone 3 months ago. You had the money, you blew it. I think that's important. A lot of people could make a much better increase in their life if they followed these principles, even of, if you get that bonus, instead of going and getting the iPhone 12, find an iPhone 8 for a third the price and save that extra $600.
Yeah, exactly.
Or if you're going to go get
because
a car, why
it's
would you
not
buy a brand new one?
What some people look at savings as is they say they're just throwing their money away. I think some people have a spending mentality, right? They have this money, they're not used to having money in their hands, so they spend it immediately because they want to have something from it. But when you invest your money, when you save your money, you're not losing it. It's actually growing for you. You can take it out whenever. It's not lost. So instead of buying that iPhone 12, again, if you buy the iPhone 8 for a third the price, you still have that money that you could spend in the future. Maybe the iPhone 14 comes out and you've invested and you've saved enough money. Get the iPhone 14, right? I mean, you have these investments, you have that saving. And obviously, if the rainy day happens, you have it. But one point that I kind of want to make too, again, with everything crazy going on in the markets, this is not the first time it's happened. If there's a movie that I would recommend that people watch, it's fairly realistic. There's a little bit of dramatization in it. It's actually about the financial crash in 2008, and it's called The Big Short. And it actually explains quite well what caused the market crash in 2008. And there's, papers published on this, there's resources. I won't explain what happened in 2008, but in short, what happened, there's a scene in the movie. And there's this hedge fund manager, and he goes to a strip club, and he's talking with this stripper, and the stripper's talking about these new condos that she bought. And she's saying, yeah, I just bought my 5th condo today. And the hedge fund manager's like, what do you mean your 5th condo, right? And she's like, oh, like I just bought a 5th condo. And he was like, well, how much money do you make? She doesn't make much money at all. And he's like, well, how can you afford to buy all these condos? And what was happening is there's something called refinancing. And how refinancing works on a mortgage is, let's say a house is worth $100,000 today, right? You invest or you put in some amount of money towards that mortgage today.
Yeah.
If the house becomes worth more and more money, as what was happening prior to 2008, there's a huge boom in the real estate market. Let's say it's worth $200,000 in 2 years. Well, all that money that you put in is now worth double, right? Because the house is worth double what it was. And so you can actually refinance your mortgage with the bank, and they will actually lower the rate that you pay per month. So it's actually more affordable, or they can actually give you some money back that you put in with the agreement that you'll pay it back at a later date. So as long as real estate was increasing at the rate that it was, people were actually able to buy multiple condos, multiple houses, but they were reliant on refinancing multiple times. It was not sustainable, right? The second that it plateaued and they stopped increasing, people would not be able to afford refinancing, and they wouldn't be able to pay their bills. And so that scene is funny because this hedge fund manager is talking with the stripper, and at the very end of this conversation, he immediately calls his buddy and he says, we're fucked. He was like, this is the crash, right? When you have a stripper buying multiple condos, right, because she just thinks she's going to make so much money off it, she can't afford these condos, that's when they knew they were in a bubble. And that honestly is kind of what happened in 2008. There were so many people buying. What ended up happening was there's a lot of people that were buying condos and houses and real estate in general that just did not have the means to be able to purchase these properties. And there was some new regulation under the Bush administration that was passed that made it more affordable and more achievable for people to buy houses, which sounds awesome, but they weren't financially capable of actually paying these mortgages. And so there's a crash.
Right.
And so you can kind of see these same trends now, right? In 2008, you have the stripper buying the multiple condos. She can't afford it, and she can't afford to lose all that money. She's going to go bankrupt when it crashes, but she's doing it because she thinks she can make a quick buck.
Yeah.
You see the same thing today.
So he heard that story and realized that if that's possible, the overall state of the market is not in a good place for them.
Absolutely. We're in a bubble, right? And so too many people are making money too easily. And so we're in a bubble. And so you can see some of the same trends now.
Yeah, absolutely. Well, I wanted to go back to Dogecoin a little bit to kind of wrap up. What is as someone who follows the stock market, what is your opinion on cryptocurrencies and people using them not only as long-term investments, but also as an unregulated form of currency that people can trade?
So I'm actually have switched on Bitcoin. I used to not believe in cryptocurrencies at all. And the reason why I didn't believe in them is because I felt two things. And actually, these things are still kind of true. One, they're too volatile, which right now they are. Right? As a currency, there has to be some sort of consistency. Yeah. And if Bitcoin is going to be a long-term option, it has to mellow out. You cannot have these big 10% swings in a day, because imagine if your dollar tomorrow is worth like 10 cents what it is now, right? Yeah. How can that possibly be a viable currency? The other reason was I felt every single person that was buying Bitcoin wasn't buying it to use it as a currency. They were buying it because they thought it would go up, double within a month or whatever. And so I thought there was a bit of a bubble, and obviously there was a correction. And so when I started going back up this year, I kind of thought the same thing, but I've given it more thought. And I think there will eventually be a cryptocurrency option that is a long-term investment and will be a long-term currency. And I believe it is Bitcoin. I do believe, in 5-10 years, Bitcoin will be worth a lot more than what it is now. But I don't believe in these alt currencies in the slightest. The thing with Bitcoin, and I would much rather have someone else speak to this, but there is a finite amount of Bitcoin that is available to ever be mined, right? So there's a sort of artificial scarcity that exists. Yeah. There's only so many Bitcoins that will eventually exist in this market, as the same with all other cryptocurrencies. That's what makes them somewhat valuable, right? You can't just print Bitcoin, you can't print Dogecoin or anything else, but Dogecoin has a lot more coins available than Bitcoin has. So inherently, it won't be worth as much money as Bitcoin because there's just a lot more available. I think eventually there will be like 120 million or so Dogecoin versus only like 22 million Bitcoin.
Okay.
And the thing is too, is what makes any of these currencies valuable is people having faith in them, right? I truly only see one cryptocurrency having value in the long run. You can't have multiple. It's just going to be one that everyone believes in and everyone uses. I think right now the highest chance for that is Bitcoin, unless something crazy comes out about Bitcoin.
And because I used to keep up with it quite a bit more. And from what I understood was that Bitcoin technologically, like just from the way that it's constructed, isn't as advanced and isn't as, it's not the best option in terms of cryptocurrencies, but it's the most popular. So what we may see is that in the future, people realize that some of these altcoins are better suited for the purpose that Bitcoin was meant to serve. And Bitcoin may fall off and not be as popular anymore, and those may take its place. And especially, I would encourage people to read up on Ethereum. I don't know if you know a lot about Ethereum, but just as a blockchain technology for information, it's a really cool technology that it's not just contained within this currency bubble. Like the technology behind Ethereum, and it's very complicated. I'm not going to pretend to understand it. That's why I would encourage people to read up on it. And I definitely wanted to do some more research myself, but it's like the technology behind Ethereum could could be applied to other fields of technology, which is really interesting that it's being used as an investment right now, but in the future
Could be a lot more.
it could go towards the next version of the internet, the next version of any kind of technology that we may not even think of right now. That's why I think cryptocurrencies are so fascinating, because
It really is
one thing as an
fascinating.
investment, but as a technology, it's way more fascinating, I think.
And it's definitely something that I'm just not very well versed in, so I obviously won't act like I understand it
Yeah,
too well. And again, very well could be Ethereum in the future. Maybe it's some other altcoin that ends up coming out. It
right.
can't be all of them, right? Like it
Exactly.
just can't. And so right now it's risky. Right now I wouldn't really consider any of them to really be currencies, because the goal is one day it acts as a currency.
Yeah.
And so whether it's Ethereum, whether it's Bitcoin, whether it's something, I strongly believe there will be a cryptocurrency in the future that is very valuable. I just couldn't tell you right now what that cryptocurrency is. And obviously, if I knew what it was, right, then I would
Yeah.
just put all my money in it.
And you wouldn't tell anyone.
I would. Well, I mean, why would I tell anyone? I just, keep it for myself. Maybe tell a couple of good friends, what have you.
Yeah.
But anyone who's acting like they know what's going on, I mean, they don't. They don't. I mean, no one can read the future. It's the same thing with investing.
Yeah.
You just need to stay as informed as you can and understand the decisions that you're making. And what I would say to anyone who's interested in investing in cryptocurrency is I personally still consider it a risky investment. I do not judge cryptocurrency on the same scale that I judge investing in like an S&P 500 ETF, right? Or investing in safer stock picks, right? So I will invest money in cryptocurrency that I'm willing to lose, because I don't think it's safe enough quite yet, because it could lose, it could tank, and then you lose all your money. So if you want to invest in cryptocurrency, that's awesome. But I wouldn't put all of your savings in cryptocurrency, because I do think it's just right now, it's just a bit too unsafe to assume that in 10 years, you can be positive that you'll have your money and more.
Right. Yeah, it's very risky, and exactly what you said. Don't listen to anyone who claims to know what's going to happen. I remember back in, how many years ago was that? I think it was like 2016, maybe 2017, when cryptos really blew up. Everyone was predicting what was going to happen. Oh, it's going to be worth $100,000 in 6 months.
Yeah.
Oh, it's going to crash. Now here we are, 2021. It's worth, what Bitcoin's worth, about 34,000. Last I checked,
34,000, round of there.
something
Yeah.
like that. So exactly, think critically about it, and don't listen to what people say about it, or
Yes.
listen to what they say, but don't take anyone's word as fact, especially
Exactly. And
speculation.
that's the biggest thing. At the end of the day, if I'm investing, it's my money on the line. So I'll read the opinions of others. And obviously, a lot of people are more well informed, they're smarter, they understand it a lot better. You just can't trust any one word. And you definitely can't trust someone that acts like they know with absolute certainty what will happen in the future. Because
Yeah,
unless we have a time machine, that's just not possible.
especially because a lot of people who are probably going to speculate about this stuff likely have some gold in the pot, and maybe it's in their
Exactly
best
what it is.
interest to tell you that it's going to be worth a bunch of money. Maybe it's in their best interest to tell you it's going to tank. And I think, if I understand correctly, that probably applies to the stock market as well. Anyone in the stock market who's trying to tell you what's going to happen or give you advice, they likely have some foot in the game
Some sort of
too.
skin in the game. Absolutely.
Yeah. So you gotta be careful of that, and like you said, stay informed for sure. So is there anything else you wanted to talk about? Anything else that's important to
I
this?
mean, honestly, I feel like this was, an incredibly interesting discussion. I really got a lot talking with you today,
Yeah.
and I think really it was cool because we were able to cover the gamut of not only just GameStop, but just more macro ideas in general, and then also how that relates just to the average person.
Yeah, for sure. I
Um,
appreciate that you stay informed about this stuff, and I definitely like having someone who knows about this stuff, and someone who's in college for, like you said, you're in for your degree is what? International business
is it
with.
international business, economics, and Russian?
Okay, sweet. Yeah, so it's really interesting. And I appreciate you coming on and talking about this stuff. I got a lot out of this too. I barely understood this stuff, and now I feel like I could at least explain it to someone reasonably well. So I appreciate you coming on. I definitely look forward to talking to you again in the future. And let me know when you're in town. We'll try to get up and do
Yeah, no,
something for sure.
absolutely. This summer when I come back, we'll definitely grab lunch or whatever. But thank you so much for inviting me on your show, Corey. It was a
Yeah, of
pleasure and
course,
an
bro.
honor to speak with you today. And I
Yeah.
look forward to coming back.
Yeah, I appreciate you, bro. Take it easy, man.
You too, man.
All right, see you later, bro.